Joining us right now is Joe Amato. He's the president and chief investment officer at Neuberger Berman, which has $509 billion in assets under management, and they're not all in Bitcoin, I don't think.
They are not.
They are not. Maybe they should be?
Given that it's up 47% since the election, I guess we missed it. But it's been certainly an interesting ride. And I do think there are developments there from a regulatory standpoint, potentially a legislative standpoint, that have built some of that enthusiasm, together with a little bit of the sort of animal spirits that have been created since November 11th.
What do you tell clients about Bitcoin?
Well, we tell them to be very careful. Look, I admit I've been a skeptic over the years because of some of the things that you just quoted Powell on in terms of its store of value. It's not a currency equivalent, right? It is a speculative asset. And we say be very, very careful. Be very careful. We don't have it in client assets right now. There are ways to play it through the exchanges. But certainly it's getting the attention, and we're getting lots of questions about it.
40% since the election, but 60% ARR for 15 years, or 10 or 15 years. So, I mean, you've missed it.
We have missed that.
Yeah.
We did miss the U.S. equity market, though, so we got that, which has been a strong performer over the last
He's got that
decade.
going for him.
Absolutely.
Well, the other question, therefore, is which, what's wagging the dog here? What's the dog and what's the tail in terms of this market?
Well, I think you have as I referenced, sort of the animal spirits and the enthusiasm. You have an administration that is perceived as being pro-growth and pro-business friendly. So I think that's helping. I think you have the unique dynamic where you've got an economy growing above trend line, you've got earnings growing, and you've got the Fed cutting rates. Right, it's quite rare the Fed cutting rates when earnings are growing and the economy is growing above trend line. So obviously it's about inflation and the trend line on inflation. So that creates a good dynamic for risk assets, and so it's understandable. Now, and then you add in the notion of more deregulation, which I think is maybe the secret weapon here. Right, there's a lot of talk about this administration tariffs, which clearly have implications around potentially inflation and other aspects. But deregulations, it's cost-free for the government to focus on, right? You delayer some of that deregulation, and you'll see more.
Well, so that's the question, though. How you see these CBO reports or others that will come out with reports about what's going to, what the economy is going to do, or what could happen if you do this and this. From a deregulatory perspective, how do you math that out?
No question, it's hard.
Right. With tariffs, you can just go, okay, I can do the math. I can see what's happening.
Certainly, some of it is anecdotal. Like, we see management company CEOs and CFOs come into our offices literally multiple times a day, right? And they consistently talk about some of the challenges, not just the last 4 years, but the layer upon layer upon layer. Because new regulations never eliminate old regulations; they just got lopped on top, right? So that delayering, it's tough to gauge, but I think you will see more investment and enthusiasm from companies more willing to say, look, I don't have a headwind right now with policy. I have a tailwind.
I tried to push Powell a little bit on the issue of cutting rates, given the issues that you're talking about. Do you think it's a mistake to cut rates? I
don't think so. I think when you got the trend line on inflation and where policy rates are and effectively where real rates are, it's still restrictive. Now, whether, I think you referenced, he's trying to find neutral, or is neutral 3.5? Is it 4? It's not 5. It's not 4 3/4. So there's room. And I do think with any sign of labor market weakness, we'll get a big number on Friday. The Fed has lots of room to cut even further. So we're assuming 25 in December. Sorry, Becky.
What about any sign of inflation? Like if the labor market weakness would move them in one direction, would inflationary pressures picking up move them the opposite direction?
I think the inflationary issue that we've gotten over and got past is, when inflation's 5, 6, 7, 8, that's a disaster, and central banks have to deal with that. Now, if you're arguing about 2.5 to 3 or 2 to 3, and the pace at which you get to your target rate, there's no magic to 2%. But the trend line, we think, is still favorable, and some of the stickier areas will remain challenging, like housing. But a lot of the other things that were a function of misalignment of supply and demand have been worked through. And, you'll have a bumpy road, but we think the trend line direction of travel is still lower.
3.5 is a big difference than 2. And I mean, it hurts and badly over time. I mean, 2 is a good number in terms of
for sure
of optimal.
And that's why one of the things that the market's trying to wrestle with tariffs, because it's hard to see how tariffs are not inflationary if they get put in place. Right? If you go back to 2018, the goods that were tariffs are placed on, if you did a price composite at, they're probably at 3 to 4%.
When clients say what's going to really happen with tariffs, are you in the Ken Griffin camp, which is we just don't know, and they're probably not going to happen? It's a negotiating tool, and that's what we're talking about.
We think tariffs will net be higher, but we think it is absolutely a negotiating ploy and transactional, and you're seeing that between the incoming administration in Mexico right now, where they're engaging in discussions that probably leads to some type of deal. But I think directionally, China, potentially on some of the other countries, you'll see a bit more, but not as much as people fear.